Hey plan sponsors out there, we're going to talk about how we educate our participants on avoiding early withdrawals. Now for those of you who don't know, I'm Chris Price. I'm one of our certified financial planners we have here, one of the retirement income certified professionals, CHFC, RKP, and all the other stuff that comes along with it. Now honestly, a common and costly mistake is someone taking an early withdrawal from their retirement account. So today, we're going to actually look at 4 ways to educate participants on why they should avoid taking early withdrawals from their retirement account. And those retirement accounts are like 401ks, IRAs, profit sharing plans, DB plans, that kind of stuff. So number 1, loss of future potential growth. So when you take money away from your 401k and other accounts like that, you obviously lower the balance that you have to invest. Now, when we're talking about rates of returns, your rate of return could be or maybe would be the same thing if you had $1,000 invested or $100,000 invested. But the dollar amount made on $100,000 will be a lot greater than the dollar amount made on $1,000. And this doesn't even take into effect what compound interest would mean to it. Now, most of you have heard the term compound interest. Basically, compound interest is money made off of money that was already made. So right, you had the amount of money you gave, that amount of money made some money, and then the part that made some money for you. Pretty much that's what it means. And actually, this is such a powerful thing that a guy like Einstein is stated by saying compound interest is the most powerful force within the universe. So it's something we want to take into effect when we talk about our retirement account. And if you're younger, this is only going to be a multiplier effect because you're going to have more years where compound interest is not going to be able to work on your side. The next one is your distribution might actually be lower than you think. And it's because the IRS not only taxes you, but gives you a 10% penalty. Now I see numerous of individuals surprised when the check that they get is actually a lot less than they thought. That's because the IRS is going to penalize you at 10%. So for example, if you had a $10,000 distribution, besides your taxes, $1,000 will come out and given to the IRS as a penalty. Now I'll be honest with you, there are some exceptions to this rule, but majority of the people I see don't really qualify. Some of the exceptions include like burials or funeral expenses, maybe facing foreclosure, significant medical expense, things of that nature. But not only do you have to qualify, but you got to show proof of this. And if you can't do that, you're going to have that 10% penalty. It's a pretty steep penalty above and beyond the taxes that you would be normally paying on that distribution. Now the third is you might pay a lot more in taxes to Uncle Sam, even besides that 10% we just talked about. When you take a distribution from, let's say, a traditional 401k or traditional IRA, the withdrawal is taxed at ordinary income. Now, this is on top of the ordinary income you've already been paying that year. So not only will you pay the taxes on all the money that you made that year, but this amount that you're taking out is going to be on top of that. And how our tax rate works is the more money you make, the more money you pay. So you might be someone who is at a 20% tax bracket right now, but that will increase if you took a large enough distribution to 25% or 30%. So you have to pay that taxes, and additionally, you have to pay that 10%. Now, one of the 4th reasons too, not commonly thought about, but distributions may not or most likely will not be protected against creditors. So if you're going through any kind of lawsuit or something of nature, and you have money in your 401k or your IRA, most state laws say that that money cannot be touched by creditors. That's your money, they can't touch it, it's for your retirement. But once you take that money out of that retirement account, it automatically becomes available to those creditors. Again, there's some exceptions to pretty much everything, but very, very rare are those exceptions there. So not only may you be taxed, but you also might be penalized if you have any of those creditors or those issues from just personal financial life. So if you can do yourself a favor, don't take money from your 401k, from your retirement account. Now, those are just 4 short and easy ways that we can maybe answer questions to deter people from maybe making a mistake that will affect them later. There are hundreds of other ones, sure of it. If If you guys have any questions on it, you could go ahead and leave a comment or send us an email. Like always, we'll make sure we reach back out to you. Hope everyone has a great day, and I look forward to seeing you on the next one.